So dividend aristocrats have raised their dividend for 25 years, while Dividend Kings have raised their dividend for 50 consecutive years. I've found 9 attractive Dividend Kings for you to consider adding to your portfolio for income and stability. Hey, what's up? I'm Russ. Thank you for making me a part of your investing journey and joining me while I weld my way to fire and sharing knowledge with you that I've picked up in almost 20 years of investing. Hey, if you're currently processing oxygen, give this video a thumbs up and let's get it on. When I think of stability and income, I think of bonds. Utilities are like bond proxies because they're regulated by the government, have a near monopoly, and income is just about guaranteed. So first up is Northwest Natural Holding Company, which is currently at $46.78, and they provide services to residential, commercial, and industrial customers in Oregon and Southwest Washington. Utilities are currently the worst performing sector in the market this year, which means opportunity. Now, if inflation sticks around, utility stocks could suffer further if regulators do not allow higher raw material costs to be passed through to consumers. But also, President Biden's spending plan includes support for renewable energy investments to help reach his clean energy goal by the year 2035. Their dividend yield is 4.13%, which is about 27% over their 5-year average, and they just raised their dividend for the 66th consecutive year. Northwest Natural Holding is definitely a utility company you should take a look at and consider locking in that over 4% dividend yield. I love 3M because they are literally a part of the fabric of our lives with their Thinsulate product found in many winter gloves, as well as worker safety, U.S. healthcare, industrial, and consumer goods. 3M is currently trading at $180.80 per share and has a price to earnings almost 20% below their 5-year average. Now, many investors are worried about supply chain disruption, labor, and raw material shortages, which could lead to revenue and profit shortfalls. So this too will eventually pass, and long-term buy and hold investors could be rewarded by acquiring companies that can charge a premium for their products and services. 3M's current dividend yield is 3.27%, which is about 12% over the 5-year average, and they have increased that dividend for 63 consecutive years. Analysts have a current price target of $193.46 on 3M, which would be about 7% upside from here. 3M spends about 6% of net sales on research and development, which should help position this Dividend King to be an industry leader for years to come. Now, any serious dividend growth investor likely has exposure to Johnson & Johnson, which is currently trading at $163.72, and I keep buying more. J&J is so solid because despite continuing concerns over coronavirus issues and potential new U.S. policies that could affect drug prices, they're largely insulated, 3M Thinsulate style insulated, due to their diversity across 3 segments: consumer, pharmaceutical, and medical devices, and their primary focus being products that are related to human health and well-being. J&J's current dividend yield of 2.59% is about 2% less than their 5-year average, while analysts have a price target of $188.29, which would be about a 15% upside from here. They're hard to manufacture products on top of their segment diversity should help insulate J&J from economic downturns, and their dividend, which has been increased for 59 years, offers a defensive growth and income opportunity. J&J is easily my top dividend stock, and it is honestly never a bad time to buy a compounding machine. Just like J&J, I think almost everyone is familiar with Colgate-Palmolive and their near ubiquitous products, which means they are just about everywhere. Their stock is currently at $75.50, and from personal care to pet nutrition to home products, they've come quite the way from their founding all the way back in 1806. Now, while the U.S. consumer defensive market continues to lag behind the broader U.S. equities market, pressured by those same supply chain constraints and rising labor and material costs, deals can be found. So in particular, we should look for companies with strong balance sheets and pricing power. I love that Colgate has been consistently buying back shares, increasing their sales and their free cash flow, and has not only increased its dividend for 58 straight years, but has paid uninterrupted dividends on its common shares since 1895. Analysts give Colgate-Palmolive a price target of $85.90, which would be an increase of about 14%, and their dividend yield of 2.38% is about 2.50% above their 5-year average. So if you're looking for a solid company that has products we need and use in our everyday lives and a stable and growing dividend, take a good long look at Colgate-Palmolive. What lasts longer than a can of Spam? Hormel's dividends, which they've been increasing for 55 years, and their current stock price is $42.01. Now, much like Colgate-Palmolive, they have brands that are well established in consumer nutrition, and they are beginning to expand internationally. So it's true that their grocery products segment has had flat organic revenue growth the last several years, but Hormel is a well-managed company that should help them navigate a rapidly evolving retail marketplace. Their dividend currently sits at 2.33%, which is almost 22% above the 5-year average. Hey, and if you're ever in Austin, Minnesota, make sure to check out the Spam Museum just like we did and get yourself some hot and free samples of Spam. Now, sin stocks are always a hot topic, but you know I love companies that can provide products to adults in a quality-controlled way and make the risks clearly known. And Altria is a wide moat company that many dividend investors love and is currently trading at $48.22. While cigarette manufacturers know they are living on borrowed time with cigarette consumption steadily declining, as Altria is moving beyond smoking by investing in smokeless products, and they even own a 10% stake in Anheuser-Busch and a 45% stake in the cannabis company Cronos. They have low capital requirements, which allows the company to return capital to shareholders in the form of an 80% dividend payout ratio, which is currently at a whopping 7.47% and has been increased 56 times in the past 52 years. Analysts give Altria a price target of $54.91, which would be about a 14% upside from their current price. So I'm still buying Altria, and yeah, while cigarette sales are steadily declining, they have such a wide, massive network that they've built that will allow them to acquire new technologies and trends to remain profitable for years to come. Leggett Platt is one of the most boring and unsexy companies around, but responsible for the design and manufacture of many bedding, furniture, and flooring products like mattresses, automotive seating, sofas, carpet cushions, and draperies. These are the companies that I just love to keep buying up, and their stock is currently at $47.39, which is 21% below their 5-year average. And analysts give Leggett Platt a $57.25 price target, which is almost a 21% upside from here. They're a solid company with a really low 48% free cash flow payout ratio and a 3.55% dividend yield. And they are a new Dividend King that just raised their dividend for the 50th consecutive year. Companies like this are just fantastic to buy, hold, forget about, and collect the dividends year after year. And now that you're familiar with Leggett Platt, as any serious dividend investor should be, you can consider adding them to your portfolio. And once again, utilities are one of the few places in the market for stable income while treasury rates are low. The 10-year treasury rate is currently 1.638%, but the closer that creeps up to the utility's average dividend yield of 3%, the more investors likely will jump out of utilities and into bonds. But there are still quality companies in the sector like Black Hills Corporation that provide electric and gas in South Dakota and Wyoming and are currently trading at $66.33, which is about 13% 4% below their 5-year average. So investors seeking a defensive income play should consider a utility company like Black Hills Corporation that's currently paying a 3.41% yield, which is about 12.78% above their 5-year average. And in October of 2020, Black Hills Corporation increased their dividend for the 50th consecutive year. So utilities, of course, are a great income hold, but always remember, as those rates tick up, investors may jump out of utilities, which brings the price down. And remember what we say, when price goes down, yield goes up. If you'd like to see some of the companies that make up this bridge portfolio, click the link for degrin.com, bridge portfolio, in the description below. And if you were helped in any way, shape, or form, please consider subscribing, give us a big old thumbs up. And speaking of companies that are down but solid and have nice yields because they've gone up, check out this video right here where I pick out 3 dividend companies at recent 52-week lows that I think are fantastic buying opportunities, and I will see you there.